Have you ever seen a giant just fall? We're talking about a massive, stable company, a leader in its industry, whose stock has absolutely collapsed. Well, today we're putting on our financial detective hats to solve a real puzzle, a mystery surrounding a company you've almost definitely heard of. Let's get into it. So, who are we talking about? Our subject is Nomad Foods. Now, you might not know the parent company's name, but you for sure know their brands. Birdseye, Findus, Iglo. I mean, these are staples in the frozen food aisle all across Europe. We're talking fish fingers, frozen peas, the basics. This should be a defensive, super reliable business, right? Or so you'd think. And here is the heart of the mystery. The stock has just plummeted. We're talking a drop of over 60% from its all-time high. Now, for a company that sells everyday essentials, a fall that dramatic is, well, it's shocking. And it forces us to ask a really, really important question. So what's the deal here? Is the market giving us the bargain of a lifetime? Or is this a huge warning sign? A classic value trap where a stock looks cheap for a very, very good reason. That's exactly what we're here to figure out. To get to the bottom of this, we have to do what any good detective would. We gotta follow the money. We need to look at the numbers. These are our clues. And believe me, they tell a really fascinating story about how cheap this company is right now. Clue number one, its price-to-earnings ratio is just 7.8x. To put that in simple terms, it means for every single dollar of profit the company makes, you only have to pay about $7.80 to own a piece of it. For a stable company selling consumer goods, that is incredibly, incredibly cheap. Next up, check out this dividend yield. At almost 6%, the company pays you a really high return just for holding the stock. So while you're waiting for the market to maybe recognize the value here, you get a strong cash payment. It's like getting paid to be patient. Okay, here's another key metric. One the pros really love because it accounts for debt. It's the EV to EBITDA ratio, and it's also at a rock-bottom 7.0x. This just confirms the story from another angle. When you look at the company's core operational profit, the entire business is basically on sale. And hey, you don't have to just take my word for it. The company's own founder, Noam Gottesman, has said it himself, plain as day. He believes the market is meaningfully undervaluing his company. That's a pretty strong statement from the guy who started it all. So let's really put this cheapness into context. Look at Nomad compared to the absolute giants in the same sector, like Nestle or Unilever. Nomad isn't just a little bit cheaper. It is trading at a massive, massive discount across every single one of these metrics. We're talking half the valuation or even less. It's in a completely different league. Okay, I know what you're thinking. If it's so cheap, there has to be a catch, right? The market isn't completely stupid. So let's look at the arguments from both sides. The reasons to be bullish and invest, and the reasons to be bearish and, well, run for the hills. So here it is, the core debate. The bulls, the optimists, they see these iconic brands that just print cash, and they point to a huge cost-cutting plan that could really boost profits. But the bears, the pessimists, they're worried. They see high debt, slowing growth, and really stiff competition from cheaper store brands. This conflict right here, this is the entire reason the stock price is so low. To try and cut through this debate, we can use a really powerful financial tool called a discounted cash flow model. It's basically a way of estimating what the company is truly worth based on all the cash it's expected to generate in the future. It helps us get past the day-to-day market noise. Now, don't worry about the complex math here. The logic is actually pretty simple. First, you project all the cash the company will ever make. Then you calculate what that huge pile of future money is worth in today's money. That gives you a data-driven estimate of the stock's true or intrinsic value. And the results are just staggering. The base case, our middle-of-the-road estimate, suggests the stock could be worth over $38 a share. That's a 225% upside from where it is today. But here's the most compelling part for me. Look at that pessimistic scenario. Even if things go poorly, the model suggests the stock is still worth almost $21. That's a potential 74% upside even in the bad case. That right there is what investors call a margin of safety. So after looking at all the clues, the valuation, the arguments for and against, and these potential futures, what's the final verdict? What's the solution to this deep value mystery? You know, the analysis really points to one powerful conclusion, and it's best summarized by this quote from the source material. This isn't just a cheap stock. It appears to be a textbook case of deep value, where the market price seems to have completely detached from the company's fundamental worth. So let's just recap the key takeaways here. The stock appears incredibly undervalued based on all the key ratios. That high dividend and strong cash flow give you a nice cushion, a margin of safety. Yes, the main risk is slow growth, but there's a huge efficiency plan already in motion to boost profits. The entire opportunity really hinges on one thing: believing that the market's pessimism is just totally overblown. And that leaves us with one final provocative question. Has the market overreacted so much to recent problems, things like bad weather and inflation, that it's completely ignoring the fundamental value and future potential of Europe's frozen food giant? That's the billion-dollar question that investors now have to decide.